All right, Ben, we're back. In our last episode, we talked on the impact of the One Big Beautiful Bill on entrepreneurs. And in this episode, we're going to talk about the impact on individuals. So I'm super excited to hop in. If you want to go ahead and do a quick intro of yourself in case anyone didn't watch the last episode, let's go ahead and do that.
Perfect. Thanks, Kaylee. Thanks for having me. Yes, I'm Ben Platt. I'm the founder and CEO of Tembo CPAs, the firm for entrepreneurs. And yeah, we're very excited about the One Big Beautiful Bill in terms of its tax implications. Maybe we'll do another episode at some point on the downsides of the bill in terms of the deficit. But from a tax perspective and wearing my CPA hat and representing clients who we are trying to minimize tax for, it's a great bill. On the last episode, we talked a lot about entrepreneurs and the impacts on entrepreneurs. So on this one, we're going to talk about individuals and the impact on them because there's some pretty cool new features in here for individuals. So yeah, let's dive in.
All right, sounds good. So, did the One Big Beautiful Bill eliminate tax on Social Security?
That's a good question, right? So a lot of people have. There was a lot of press. Well, first of all, it was one of the things that the Trump platform, had when they were running was let's eliminate the tax on Social Security. I mean, it turns out taxing Social Security is a relatively new feature in the tax code. It was introduced in the 1983 update to the code, and so prior to that, it wasn't taxed. But I think, as everybody knows, the Social Security fund has been running low and is bankrupt or nearly bankrupt or whatever, right? So they're trying to find ways to create more revenue, and so taxing Social Security became something that happened in 1983. In my lifetime, we're all used to it now. um, but it was one of the things that the Trump platform was to eliminate the tax on Social Security. Unfortunately, the One Big Beautiful Bill did not do that. So it did not eliminate the tax on Social Security. What it did do instead is create an extra deduction or exemption for people who are 65 and older. So generally speaking, those are the people who are receiving Social Security for an extra $6,000 per person, right? So if you're married filing joint, that's an extra $12,000 deduction in addition to the standard deduction that you qualify for simply by being 65 and older. You don't even have to be receiving Social Security. So they kind of detached those two pieces and said, all right, we can't do the eliminate tax on Social Security, but we can create this deduction over here for people who are 65 and older. And so let's just do it that way. I think generally speaking, if you're married filing joint, it's probably going to save people somewhere between $1,000 and $1,500 a year, I would say, on average in tax. So it's good, and it's a good thing to know about. And the only thing you have to do to qualify for it is be 65 and older. So it's an easy thing to qualify for if you're already in that bracket. It is worth knowing that it's not a permanent change; it's a temporary change. So it'll be around for the tax years 2025, so this tax year, through 2028, so the next 4 years.
Well, I guess that one won't affect us, but
No,
that's okay.
I don't think we'll be able to capitalize on that one, Kaylee. We've got a couple of years. You
I
more
do
than me.
I know. I do see though that there are some new deductions for individuals that are earning either overtime or tips, and then there's also a new deduction for car loan interest. Sure, there are some limitations to this, so can you kind of touch on all the deductions and what the limitations might be?
Yeah, for sure. I mean, I think the a couple of these are pretty exciting. It was interesting following these in the news, right? So we saw the news about overtime, and we're going to eliminate the tax on overtime. We're going to eliminate overtime from being taxed, rather. We're going to eliminate tips from being taxed. The car loan interest thing wasn't even something I saw a lot of news on, so it was a little bit of a surprise to me when I read it in the code or in the bill. So, but let's just kind of take these one at a time because I think there was like a little bit of a I don't want to say bait and switch, but it's being from a practical perspective, it's being handled differently than the way that I think people thought it was going to be, especially the overtime and the tips, right? So if you are currently being paid overtime, right? So you worked 50 hours last week, and 40 of those were regular, and 10 of those were overtime. Those 10 hours that you're paid overtime, and let's say you make I'm just going to make the math easy here. $20 an hour, right? The overtime rate is say another 10. right? So you're making $30 an hour for 10 hours, right? The overtime piece of that, the $10 an hour overtime rate, is what they're trying to exclude the tax on. Okay. So $10 an hour times 10 hours, this $100 in this example that I'm using is what they're trying to exclude the tax on. I think what people thought was going to happen was that when they got their paycheck, that $100 was going to not be taxed, right? But that's not how it works. And if you think about it, that would be unbelievably difficult to handle from an employer's perspective. All new tax tables and like trying to differentiate between these things and be able to show an employee, like, here's the tax on your regular wages, here's the tax on your overtime where only half of it's taxed or whatever, right? So that would have been extremely difficult. So the way they handled it is they basically said, when you get your W-2 is going to differentiate between your regular wages and the overtime premium, right? So even in those 50 hours that you worked, the 10 hours that are paid at your regular rate, that's still going to be taxed as normal. It's the 10 hours at the higher rate, the difference in rates is what's going to be excludable. And the way that they're going to do it is that they're going to say, depending on what that number is on your W-2, we're going to give you a deduction for that amount up to $25,000 if you're filing married, filing joint, right? 12.5, $12,500 if you're filing single. So it in the end, it all basically gets reconciled on the tax return, right? It's not going to affect what people's pay stubs are, what your paycheck is week in, week out for the rest of this year, or between now and the end of 2028. And so this is a temporary rule as well. There is a $300,000 married filing joint phase out. So if you make more than $300,000 married filing joint, then you're going to see that deduction start to get smaller. I actually don't know what the top side of that is. Probably 400,000. Anything above 400, you don't get that deduction for the overtime pay. The tips work very, very similarly, right? So the OBBB included this provision that basically said we're going to exclude up to $25,000 of qualified tips. Again, $300,000 phase out, married filing joint. So it's $25,000 deduction. It does not affect your paycheck, between now and the end of the year or next year or the year after that. It's all going to get reconciled on your tax return. So you'll have to file your tax return. You'll claim this deduction for up to $25,000 of qualified tips. And so it'll reduce your taxable income because in the past, tips, have been taxable. And so you pay tax on that. That's kind of the way that they're handling the no tax on tips. It's really no tax on tips. Well, actually, no, you're going to pay tax on the tips until you file your tax return. And then when you file your tax return, there's no tax on tips as long as it's less than $25,000 and your income doesn't exceed $300,000, right? So, like everything in the tax world, it's super complicated and there's lots of details that you have to know. It's also worth noting that the no tax on tips only applies to jobs where tips are customary. They have expanded that a little bit more. Like beauty salons used to not be in the job, the description of jobs that customarily have tips. But we all know we tip our people who take care of our hair and nails and all that stuff, right? So they have expanded the definition to include several other categories that are customarily, tipped employees. I've had clients, that are in businesses that definitely are not customary tipped employee businesses say, hey, can I just, like, I've been paying this person $1,000 a week. Can I pay them $800 a week as wages and $200 as a tip? Right. Well, I mean, I can appreciate their creativity there, but it's not going to work. Right. First of all, if it doesn't fall into the category of businesses that, where tips are customary, it's not going to work. Second of all, the tip has to come from the customer. Right. So it's not the employer who's paying the tip out of the employer's pocket, right? It's the employer that's a conduit. The customer pays the employer pays the employee, right? The tip. So reclassifying, what were wages to tips is, I just don't think going to work. Now, maybe when the regulations come out, there's some workarounds there, and we'll look at those and find out. So the other thing that doesn't have anything to do with wages like overtime and tips is the car loan interest. So this is the one that I didn't know a whole lot about, but the one big beautiful bill basically treats car loan interest as deductible up to $10,000 a year. Again, this is temporary, 2025 through 2028. The phase out's lower, so if you make more than $200,000 married filing joint, then that deduction starts dropping. Interestingly, this is not a itemized deduction, right? So, like mortgage interest right now is deductible, right, on your first $750,000 of principal residence mortgage balance, but that's an itemized deduction, right? So you either itemize or you take the standard deduction, and if you itemize, you can take that mortgage interest deduction. The car loan interest is not an itemized deduction; it's what we call an above the line deduction. So you can take the standard deduction and take the car loan interest deduction both, right, at the same time. Um, and that actually applies to the overtime deduction and the tips deduction as well. None of those three are itemized deductions. So you don't have to itemize in order to be able to capitalize on those three deductions. So I think that's very cool.
Yeah, that's very interesting. I'm sure a lot of people will be disappointed in the first two, but the third one's pretty cool.
Yeah, yeah, yeah. I mean, and I think the reality is that the majority of people that earn overtime and are tipped are under those thresholds, you know, and so the majority of them are going to really benefit from those new rules, and it's going to save them tax, and they're going to be happy about it. I mean, the people who honestly makes it so complicated for is us. Like, what used to be a simple tax return is now going to be a very complicated tax return.
Yeah, yeah, definitely. Um, so switching gears a little bit, I know Tembo does a lot of estate planning for its clients. So how does the One Big Beautiful Bill affect estate planning?
So how does the one big beautiful bill affect estate planning? We do help with quite a bit of estate planning, always in conjunction with a tax attorney. That's our preference. I think that's our client's preference as well. We don't draft legal documents, so we're really just there to help them understand what are the tax implications, what are the financial implications, how does this affect your family, how do these things flow, that sort of thing. Um, and it's important, right? I mean, we mostly work with entrepreneurs, but there's going to come a point in time in every entrepreneur's life, when they sell their business or want to pass it on or transition the ownership to family or key employees or whatever, right? So all of this factors into the estate planning. So we've actually been doing a lot of work over the last couple of years with clients that are in the 15 to 30 million dollar net worth range, right? So like couples that are in the 15 to 30 million net worth range. The reason is because the current estate tax exemption, right, was set to expire at the end of this year, and it would drop the estate tax exemption to the pre 2018 levels. And what that was going to mean is that people who had estates married filing joint between 15 and 30 million as of today, right now, or last year, would not be taxable. But as of January 1 of next year, would be taxable, right? So if you fell into this 15 to 30 million range, you really needed to pay attention to what your planning was going to be. And if the One Big Beautiful Bill had not addressed this, between now and the end of the year, we would be doing a ton of planning for clients that are in that 15 to 30 million range, making gifts and trying to take advantage of the gift and estate tax exemptions that exist right now. So fortunately, the One Big Beautiful Bill did address these. They took the existing exemptions and they made them permanent. So essentially, it's 13 today this year, 13.99 million, $14 million per person of exemption indexed for inflation. So in a married filing joint couple, that's $28 million, right? So you can have a $28 million estate, die, both of you die, pass it on to your kids or whoever you want to leave it to, pay zero estate tax, right? That's what that means. Um, and again, that was supposed to go back to like 7.5 million per person at the end of this year. So we don't have tons of clients in that 15 to 30 million dollar range. I would say most of them are lower than that. But we certainly do have quite a few that are in that range. And so we've been spending fair amount of time with them, talking about what that planning looks like. And then now that we know that this is what the rules are going to be moving forward, now a lot of planning happens with the people who are over the $30 million net worth range too, right? Because now we know, like, okay, your estate's gonna be taxable over this 30 million amount. And that's gonna be indexed for inflation. So, but their net worth keeps growing too, right? So we're gonna have this, this kind of gap that we're forever gonna have to be dealing with from an estate and gift tax planning perspective. So it's good to know what the landscape is. It's always good to have like solid ground under your feet when you're trying to do planning. I think that's been the really challenging part over the last couple of years, is that all of these things were set to change and were going to change, but for the fact that, new legislation had to be passed. And so we've been on unstable ground for the last few years. Now we have very stable ground, and it's going to make the planning much, much easier.
Yeah, that's awesome.
Yep.
There's been a lot of conversation about opportunity zones and potential tax savings there. So how does this new bill affect these?
Okay, so opportunity zones, very complicated. The 2018 Tax Act created the tax the tax opportunity associated with opportunity zones. Okay, um, so I guess let's start with like what are opportunity zones to start off with, right? So opportunity zones are like very specific geographic territories, right, that you can see on a map that have been nominated by state and local governments to the Treasury Department, and then the Treasury Department certifies them, right? Essentially, it's an area that falls below a certain percentage of poverty level. It's an area in the U.S. that needs development, right? It needs economic support, right? It needs investment. And so what's happening here is that the Treasury Department and Congress are saying, in order to incentivize people to invest into these areas that need this economic support, we're going to create a tax benefit for them, right? So this is the incentive. The tax benefit is the incentive. Um, and essentially, how it works is that investors can invest in property in opportunity zones. They can invest in funds that invest in property in opportunity zones. They can invest in businesses that invest in property in opportunity zones. There's several different ways that investors can take advantage of this. In order for them to take advantage of it, first of all, they have to have gains. This was a very interesting rule that I learned while I was working with a client on this. And we really went like really far into this process before learning the basic fact that you have to have gains in order to make this work, right? It's not enough that you have money, okay? It's not, so I can't, if I, let's just say I have, $200,000 sitting in the bank and I want to invest in an opportunity zone fund. I can't just go over to there, that opportunity zone, take my 200,000, invest it, and get the tax benefits associated with opportunity zones. I have to realize $200,000 of gain from something that I'm selling, and then take that $200,000 and invest it in a fund or an opportunity zone, right? So you have to have gains in order to benefit from this whole scheme, we'll call it, right? That's a critical piece. Quite honestly, like if you're not well versed in opportunity zones, people just don't even know that piece. They think that they just go invest in a fund and, get the benefits. So what are the benefits? Well, the first benefit is that um, the gain that I'm reinvesting into the zone it gets gain deferral, right? I don't have to pay tax on it this year. Now, what was happening in 2018 and 2019 is that you were able to defer those gains until like 2026, 2025, and 2026, right? So there was this like 5-6 year gain deferral period. But if you think about it, it was a hard, end of 2026. So if you had a sale in 2023, like I was just working on a tax return um, for a client that had a sale in 2024, and wanted to defer that gain. Well, deferring it into an opportunity zone wouldn't make a whole lot of sense because you're only deferring it for 2 years, because it was a hard line in the sand on when you had to recognize that gain. Um, so they've fixed that now. I'll talk about that here in just a minute. The other benefit, in addition to the gain deferral, is that if let's say I go over here and I buy, I take my $200,000 of gain and I go invest it in this opportunity zone property, and in 10 years my $200,000 investment turns into $1 million of value. Okay. And I sell it 10 years from now, 12 years from now, 15 years from now. Okay. That $800,000 gain is completely excluded, no tax, right? So as long as I've held it for 10 years, then that gain on the actual investment property gets excluded for tax purposes. That's the big incentive, right? So why would anybody do this? The reason they would do it is because I can go invest in a underdeveloped area, right, where costs of things are low, presumably, and between me and anybody else that's investing in this area, we can lift this area up economically, and we can make the values in this area higher. And 10 years from now, 15 years from now, 20 years from now, when we sell, the gain associated with all of that investment is not taxed, right? So that's the big benefit. So what they did with the OBBB is create some new rules and enhancements to this program. Okay. So the first thing that they did was that they set up this program to be extended indefinitely, right? So we've been operating in this environment where everything kind of ended at the end of 2026, and you had to pay tax on your deferred gains, and didn't make sense to invest in new properties, blah blah blah, right? So they've said, okay, we're going to solve that problem by making this program extend indefinitely. We're also going to solve the 5-year deferral period by creating 5-year rolling deferral periods. So if you recognize a gain and you reinvest it in a qualified opportunity zone, then you have 5 years from that date. That's when you recognize the deferred gain, right? So you're always dealing with this 5-year deferral period. And for investors, that's great. So at least I know I don't have to pay the tax on this gain for 5 years. What that's going to allow me to do, it gives me 5 years to make the investment, get it up and going, refinance it, and probably pull some debt out to help me pay my tax in 5 years, right? The other thing that it does is they've created a permanent 10% basis step up, right? So if I invest $200,000 in this property that we've been talking about, and I hold it for 5 years, they give you a 10% basis step up. So now my basis isn't 200,000, it's 220,000, right? And so if I happen to sell between the 5th year and the 10th year, because if I sell after the 10th year, I can just exclude the gain. But if I sell between 5 and 10, I at least get a little bit of a benefit of higher basis, less gain that I have to recognize. The other thing that they created in this version is what they call these qualified rural opportunity funds, right? So these are zones that are even further below the poverty level on average. They need even more development, even more investment. And so they've kind of supercharged those benefits. So instead of the 10% basis step up that we were just talking about, is a 30% basis step up. And instead of having to improve the property by 100%, so like the example I've been using of investing 200,000, that would be like buying a property for 100,000 and making $100,000 worth of improvements to it in order for it to qualify, right? In the rural opportunity funds, you only have to make a 50% improvement. So you could buy a property for 100,000, put another 50 into it, and it would qualify, right? So lower investment threshold, more basis step up, a little bit more incentive to invest in these qualified rural opportunity funds. All that being said, I mean, the reality is that opportunity zones they're limited. You can pull up a map. If you type in opportunity zone fund map, you can see where they are. There's a really good one where you can put in like zip codes and see exactly where they are in your location, places where you might want to invest. But I think there's really like two groups of people that should be looking at these. One is people who are very interested in, deferring the gain on sales that can't be rolled into a 1031, right? So if you're selling something other than real estate, like stocks, for instance, or business, you may want to look at this as a way to push that gain into something that can at least be deferred for a while. And then I think folks that are naturally investing in opportunity zone areas, we're in North Florida. Putnam County, for instance, has a lot of opportunity zone areas, and we've got clients in that area that are taking advantage of that. They want to invest there anyway, right? So why not take advantage of the rules on the opportunity zone funds when you want to invest in those places anyway? I think for people who are interested in learning more about all of this, we work with this company called Realize 1031. I think they're a great resource. They've got a great web page about opportunity zone funds. So they could go to realize1031.com, check that out. They also, Realize 1031 also is like they're like a broker. And so they represent a lot of these funds. And so if you don't want to do the work of trying to figure out where to invest the money, but you want to take advantage of the OZ rules, we've had some clients do that too. And I think Realize does a great job with that. So definitely recommend people checking them out.
Super interesting.
Yeah, there's a lot there.
Yeah, a lot to unpack. I have one more question, and I did just have a baby 8 weeks ago
Nice.
today.
Yay.
So I heard about the new Trump accounts, and I just want to know a little bit more about how they work
Ah,
because
yes.
that's
The
been one
Trump
question.
account. Yes. Well, yeah. I mean, you didn't even know it, but your kid is going to get the benefit of a Trump account. So if you there's two kind of time frames to think about. One is that if you have a baby between 2025 and 2028, so after December 31, 2024, before January 1st, 2029, so the years 25 through 28, then that child is going to qualify for a Trump account and $1,000 of seed money from the government. I'm not 100% sure how that works. I've heard people say that the government's actually going to put the $1,000 into the account. I'm not sure how that would actually work because I don't know how they're going to know about the account. But I think some of these rules are going to get figured out here soon. When I read the bill, the way I read it was that you would put the money into the account and then get $1,000 tax credit on your tax return, for funding that. And that's as if so the government's giving you the money for you to put into the account, basically. So either way, it's a free $1,000, and if you have a kid during 2025 through 2028, then you should definitely take advantage of it. All the free money you can get. Um, then you have the other rule applies to kids that aren't born between those years, but are under 18 during those years. Okay. And so essentially what they've done is they've created a new way to save for children, right? That are under the age of 18. They work very similar to IRAs, right? So they're tax deferred. When you pull the money out, at retirement age, it's going to be taxable income. But unlike IRAs, you do not have to have earned income in order to contribute to them. Parents can contribute to them, right? So, like right now, if you want to, if you have a child that wants to contribute money to an IRA, or you want to contribute money to an IRA for that child first of all has to have earned income, which is hard to do sometimes, and second of all, it has to be the child putting the money into the IRA, right? So it's not the parents putting the money into the IRA. I mean, we certainly have situations where children are legitimately working for our clients' businesses, and the clients' businesses are paying those children for that work, and then the money's going to the children's bank account. The bank account's then funding it into the IRA. So rather than having to go through all those machinations, parents can just say, "Hey, I want to create a Trump account. I can put $5,000 a year into that Trump account." If you and your husband want to do it, Kaylee, you can put in, as much up to 5,000, but your parents could put money in, his parents could put money in, your super rich aunt, could give you $4,000 to put in there. Right. So it doesn't really matter who the person is that's funding it. It's for that child. It's kind of like a 529 plan in that regard. And I don't know exactly what the withdrawal rules on that yet are. I think there's some rules that say that you can withdraw up to 50% of the account balance for use for school, once the child turns 18, for like higher education, college education, or for trade education. I think purchase of a first time home. So there's several exceptions to it being taxable once the child turns 18. And then I think it also is like, but it's only up to 50% of the account balance. So there is some incentive there to keep that account growing. From my perspective, and the reason that I love these things, and we've been working with our entrepreneurial clients for years and years to figure out how do we employ kids so that we can pay the kids so that the kids can then fund into Roth IRAs in particular. And even with Trump accounts, I would probably still say for the entrepreneurs that can justify employing their children, this path of employing them and having them then contribute to Roth probably is better because Roth is not taxable when they retire, and it's still tax deferred. At any rate, what I was going to say is that whether you use a Trump account or a Roth IRA account, the main thing is that you're putting money in very early in life, and you're increasing the number of compound periods that exist for that money to compound during that child's life, right? Every compound period represents double the account balance later on, right? And we've got some charts, and you can look up charts online that show what the 7-10 rule is. Money invested at 10% doubles every 7 years, or money invested at 7% doubles every 10 years. Look at those charts and think about each of those 7-year periods being a compound period. Every compound period, the money doubles, right? And so if you can start at age 1 or 0 in your case, right, instead of 18, or let's say instead of 21, that's 3 more compound periods. That means it's, double, 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 right? The amount of money at retirement, if you start now compared to starting at 21. It's massive. Like, it's millions and millions of dollars. It's insane, right? So I encourage everybody to take advantage of the Trump accounts and max those out for their children. And I don't think there's any reason why you can't do Trump accounts and do, Roth IRA if you have children who are working. So we'll look at that as the rules come out, and figure out the best way to maximize all of that.
Yeah, awesome. Well, those are all the questions I have. I'm gonna go figure out how to make a Trump account now. But do you have anything else you wanna touch on? I know we did another episode on entrepreneurs and the benefits for entrepreneurs. I'm sure eventually we might look at the downsides of the bill if there are any. Um, but is there anything else you wanna touch on?
No, I don't think so. I mean, I think yeah, we've covered entrepreneurs, we've covered individuals. I think as more and more rules come out, right? Because all we have at this point is a bill that's been passed and signed, right? The IRS has to issue regulations, they have to update the code. We've got to figure out, like, from a practical perspective, how do these things work? Schwab, Vanguard, Fidelity. I was looking there today. How do I open a Trump account? Nobody's got any information on that yet, right? It's just not out there right now. So I think as time goes on a little bit here, we'll be able to come back and look at some of the practical implications of all of this. Certainly, as we're working with clients to do planning for 2025 later this year, where are you this year? How do all of these changes that took place this year, or that are in this bill, affect you individually, right? So, I mean, I think that's the big part of what we're trying to do at Tembo, is really dial that in and say, here's what your tax, would have been without the bill. Here's what your tax is with the bill. Some sort of analysis like that. And then, here's the things that we want to make sure that we absolutely take advantage of, and minimize tax for all of our clients. So yeah, that's what we'll be working on for the rest of the year.
Yeah, awesome. Well, this interview is going to live on your Tembo CPA's YouTube. So I encourage people to comment below if they have any questions. And we'll comment back. And can you tell people where else they can find you or reach out if they want to work with Tembo CPAs?
Yeah, for sure. TemboCPAs.com, TEMBOCPAS.com. Our website has all of our links to social and YouTube, and yeah, lots of information on there about who we are and why we are who we are. And so, yeah, we love working with entrepreneurs, and as I mentioned earlier, love working with people all over the country. The power of Zoom and podcasts, and the internet just allows us to do everything we can do and do well for entrepreneurs that otherwise, I think, are underserved in many, many places. So yeah, we want to be a great resource for them.
Yeah, you're doing a great job. All right.
Thank
Well,
you.
thanks for hopping on today. I'm super excited to see how this goes over time and how people are getting the benefits.
Yeah, me too. Me too. Well, thanks so much for hosting. Thanks, Kaylee.
Of course. Talk to you later.
All right. Bye bye.